Hey guys, welcome back to another video. Today we're going to be talking about basic commercial banking terms that are used in day-to-day commercial banking jobs. So these are terms and definitions that I'm going to be walking you through, providing both the definition but also some understanding behind the concept and why it's relevant for your job. So this video is really dedicated for people that are just new to the commercial banking industry, interns or maybe junior commercial lenders, as well as people that are looking to freshen up their skills and obviously get a better understanding of some of these definitions. So just to provide a quick summary, here are the terms that we're going to be talking about in this video. There is a part one that I've already made that's going to cover some other terms, but this is the part two, and I kind of call this, level two. It's a little bit more difficult than the first one, but it covers some very important topics that are relevant to any type of business or even personal lending. So let's get into it. So let's talk about guarantee. Okay. So to guarantee something essentially means taking security, the lender taking security in the company, the person, the asset that they're lending to, or whatever thing that is the subject of that loan. So when I say I'm going to guarantee this loan against the property, that means that I'm going to lend against the property and I'm going to take the property as security. And so guarantees are the core protection a lender has, right? The very basis of me feeling comfortable in giving you money is that I have something to guarantee that. Maybe it's a business that generates profit, and therefore I'm going to take a company guarantee, right? Because I'm going to guarantee the loan against the cash flow. It could also be an asset. I'm taking a lien, registering a lien against a property, and therefore I know that in a worst case scenario, I can just take the property and sell it and recoup my original loan, and that I'm safe. So I'm going to kind of jump into the three primary methods of guaranteeing a loan. So we talked about the company. So if the business generates cash flow, you can take the guarantee of the business. Now, to do so, a borrower has to sign a general security agreement. So, guarantee is kind of the word that we use, but what does a guarantee actually mean? Well, it's essentially a legal document that a borrower has to sign, which is called the GSA, the General Security Agreement. And it's the formal contract between the lender and the borrower, which spells out essentially the security that I as a lender have, the rights that I have, if you're in default, and the rights that I have to kind of set rules in place for you as the borrower. And GSAs are used for all loans, personal, commercial, whatever the case is. A GSA is the underlying security document that protects the lender. And that is really the basis of the guarantee. Now, in addition to a GSA agreement that is signed by a borrower's company or by a borrower personally, there is the personal guarantee. And so this is the contract signed personally by the shareholders of the company or a person when they're signing up for a credit card and they're agreeing to borrow money. And similar to a GSA, this agreement spells out that that person is personally responsible for the debt. And similar to a guarantee, it spells out the rules that the lender has around going after that borrower if they default and specifies the type of security that they have. So you may sign a personal guarantee and pledge your home as security for that loan, right? As a personal guarantee, or you pledge art or cars or cash in your personal bank accounts, whatever the case is. So typically a commercial lender, and I kind of focus more commercial lenders in my video, a commercial lender will first take a company guarantee and then supplement their security if they're not confident in the company by taking a personal guarantee to make sure that the borrower is really committed to taking that loan, to paying back that loan, because now they've personally guaranteed this debt. So that's a very powerful guarantee. And then last type of guarantee is a specific guarantee. So maybe instead of a broad general security agreement signed by the entire company, maybe a company wants to just borrow money to buy one asset, a car, a piece of equipment, some property. So a specific guarantee is a targeted registration or security in that underlying asset. And so typically I look at it as equipment financing. So here's a good example. So for targeted loans like equipment financing, a specific guarantee is taken by registering the loan value and the specific lender's rights as a lien against the asset's VIN number, which is the identifying number. So there will be a trust or a deed for a house. There's a VIN number for your car. There's a VIN number for a piece of equipment. There are various ways that assets are tracked in terms of their identity in our legal system. And so when a lender registers a lien, they're going to the central government body. So it could be provincial, federal, state, whatever your province or state's governing body is. And they'll submit a claim to say, hey, I am registering a lien for the X amount of dollars that I'm lending to this asset, and that I am now the senior security on this asset. So if anyone ever wants to buy it, they're going to run a search and they're going to find that there's already a lien against it, and therefore they have to pay me back first before ownership of this asset can be transferred over. So these are the various ways to secure a loan. I would say the most common is a company GSA. GSA that's signed, that's company wide, but as well for just general specific asset lending, instead of signing a GSA and getting all mixed in with all other loans, you can just register against a specific asset and be very targeted in your guarantee. Now, in addition to guarantee, the next word that usually comes up in conversation is subordination. And so what this relates to is how lenders rank themselves, right? So there may be multiple loans made to a business, right? I have a loan for a piece of equipment. I have a loan for the real estate that the business is in, and maybe I have a loan for just general financing of the business in terms of a working capital line or whatever the case is. So how do we rank? Maybe if we're all three different lenders, what rights do you have versus what rights do I have? So what a subordination does and what a subordination agreement does is that it defines the rules and the rankings of these lenders relative to each other for that specific business, so that it defines, in a worst case scenario, who gets paid out first, who gets what type of asset proceed, sale, and et cetera, et cetera. And so when we talk about subordination, lenders rank against each other. So you can be junior to someone, or you could be senior to someone. So being junior means that you, as the other person, ranks ahead of me, and so I'm junior to you, or I am senior to you, meaning I rank ahead of you. You're my junior, I'm the senior lender, and that's how we rank against each other. So you'll hear those kind of terms being used. But subordination is critical. It's really the rules in the sandbox for lenders when they're lending to one target business. And they have to always think about, how do you kind of manage the security available to all of us, and what are our rights in terms of protection? So that's why a subordination agreement is usually signed when there are more than one lender in a business. Now, if there's one lender, they just have security over everything. There's no real dispute. You don't have to rank against anyone. But if there's two lenders, that's when you kind of get into it. And so the more junior a loan is, by the way, the higher the interest rate is, because typically now, if you're junior to me, I have seniority over you. Therefore, in a bankruptcy scenario, all the proceeds first go to me to pay off my loan, and whatever is outstanding, you as a junior lender will get. So naturally, if you rank junior to someone, you want to get paid a higher interest rate, because potentially, in a worst case scenario, you're not going to get your proceeds back. So you need to factor in that higher risk level. So junior loans are higher interest rates. Senior loans are typically lower interest rates. And then another term that I'll talk about is a cross default clause. So in a scenario where there are two or more lenders to a business, a subordination agreement is going to also have a cross default clause, meaning that when one loan goes bad and goes into default, all the other loans in that agreement also go into default. And so they all trigger a default, and everyone works together to really sort out that problem. And the reason why a cross default clause exists is, say, for example, one lender is in default and the other isn't. Well, as the one that's not in default, I don't want to force the company to sell off their assets because, you're not in default with me. We're all good. Whereas the guy that is in default, the other lender, well, he wants to try to get some money, recoup some money, maybe force the business to sell assets and all that kind of stuff. So that mismatch in objectives and direction from a lender perspective can be really, really confusing, especially for the business owner who's trying to appease one lender and also the other. So that's why lenders typically work together, even though may work from your separate companies and you have separate competitive interests. Ultimately, when you decide to lend together to a business, if one goes down, they typically all go down. And that's what a cross default clause does. And that's usually included in the subordination agreement. So let's look at an example, because I've been rambling on about senior and junior and blah, blah, blah. So consider just a business, like a commercial business, manufacturing company, okay? They have an operating line to finance their day-to-day working capital needs. And so operating lines are typically financing accounts receivable, inventory minus current liabilities. By the way, it's a definition I covered in part 1 video. And so that's the security typically that an operating line uses. Now, this business also has a term loan to finance a piece of equipment. So they've registered a specific guarantee and lent against specifically one asset in the business. And then lastly, they also have a mortgage to finance the property that they're in, the manufacturing facility. So you have 3 loans with 3 different underlying securities. So how do they rank? How do you kind of sort things out? Well, what a subordination agreement does is they're going to clearly define, okay, the operating line has seniority on the accounts receivable, the inventory, minus any current liabilities. The equipment loan, that finance that one piece of equipment, is going to have seniority and priority first on their piece of equipment that they financed. So if the operating line, say for example, is $1 million, there's only $800,000 that they recouped from their security. Now they could go next to the piece of equipment that's going to be sold off, but first the equipment lender has to get paid back before they recoup anything, right? So you can be senior specifically on certain assets. So the op line is senior on the current day-to-day working capital assets. The equipment financing loan is senior on that specific piece of equipment. And then lastly, obviously, the mortgage is senior on the real estate asset that is owned. And then naturally, once you're senior on that, if there's anything outstanding afterwards, you're paid out. You don't really care. So if the property is $2 million and there's a $1.5 million mortgage, the excess of $500,000 is then split up with the operating line provider and the equipment loan provider. But me as a mortgage provider, I recoup my money in full, so I don't really care. So that's why when lenders are thinking about subordination and seniority, they care about making sure that they're senior on assets that they can easily recoup, sell, and cover their loan. And that's why they're going to define that out. So just summarizing it here, and just to kind of talk in the lingo, the operating line is going to have a first position general security agreement, GSA, with a senior ranking on all current assets, so accounts receivable and inventory. The equipment loan is going to have a senior position and a specific lien registered to the VIN number 1.23456 or whatever for this car or this truck or whatever, and they're going to have a subordinated general security agreement on all other things. And then the mortgage provider is going to have a specific lien registered to the property. So they're senior on the property, and they'll have a subordinated GSA charge on everything else that is obviously covered. So the best way to think about it is that senior on my specific asset, subordinated on all other assets. So that's really how you would structure this. So we're talking about guarantee. We're talking about subordination. The last word that you're usually going to hear when you're talking about legally structuring is a postponement. And so a postponement agreement is when a lender's contractual right to stop payment to junior debt holders, and obviously so that they protect the cash flow of the business. So to postpone a payment is to protect the cash and keep it in the business so that obviously the cash flow is there. And so if I'm a senior lender and I didn't receive my payment in full, I have a right to postpone any other payment to the junior lender because I want to get paid first. So what a postponement agreement does is that a senior lender is going to enter into a postponement agreement with a junior lender, clearly specifying that you're subordinated, so you're below me, you rank below me. In addition to, you've given me the ability to postpone your payments so long as I get paid. Now, if I get paid, I don't really care if you get paid. So, you're going to get paid. But if I'm not getting paid or the business is underperforming, then I'm going to postpone all payments to you, and all outstanding money that is not going to really fully meet my obligations, but at least going to give me something, are going to go to me. And so this is another way and another form of security for senior lenders to protect themselves so that they rank ahead of all other junior lenders. And so postponement agreements may be between lenders. It could also be between shareholders. So a shareholder may have a loan to a company that they'll eventually want to draw that money back out of the business because they put into it to finance whatever the business or an acquisition or whatever the case is. But in that scenario, me as the third party lender, I don't want that shareholder to take money out so long as I have money outstanding to you. So I want all the money that you're generating to go towards paying down my loan before you take money out of the business. Therefore, I'm going to ask you as a shareholder to sign a postponement agreement for your shareholder loan so that I as a senior lender have cash available to me. So this is another form of security that senior lenders will seek. Now, there are terms that you'll typically hear around security value. Okay, so OLV and CMV. Okay, so CMV is the current market value, and it is essentially the current appraised value of an asset based on the current conditions. So if I were to go and appraise a truck or a property or a piece of equipment, I would get an appraiser. They would look at the general marketplace and say, today people are willing to pay $1 million for the piece of equipment. And so typically lenders will take that CMV value and use it in their loan to value analysis to determine how much they can lend against. And so, say for example, I'm going to go and lend against these group of assets. Typically, lenders are going to first ask the borrower to get an appraiser to calculate the CMV. So now we know that the assets are worth 1.5. Our general lending rules say I can only give you 75% loan to value against the assets. Therefore, I'm going to advance 75% against that $1.5 million. Now, you can take that CMV, which goes into and feeds into OLV. And so lenders will typically write down CMV and test the worst case scenario, and that is ultimately what OLV is. So when you have the CMV, you already have the OLV, because the CMV is a current value of the asset, the property, whatever the case is. The OLV is the marked down, discounted version of that valuation in a worst case scenario. And so typically OLV is essentially the estimated depressed value of that asset in a scenario where the business is underperforming or the economy is underperforming. So if we're in a recession, today these assets are worth 1.5, but if we're in a recession, there's not going to be a lot of buyers for this asset. So naturally the value of these assets are going to go down. So OLV is always lower than CMV, and it factors in that worst case scenario. Now, OLV, and I go back to this, second paragraph here, is typically anywhere from 30 to 50% of the discounted CMV value. And so that factors in an additional buffer to make sure that the lender is protected. And so ultimately, the discount rate depends on the lender's internal policies. So for the bank that I worked at, we would mark down assets at a 50% discount and real estate at a 30% discount, simply because real estate, would not fall by 50% in a lot of bad case scenarios. Whereas with equipment, maybe, it's going to more rapidly fall, and therefore the price sensitivity in a recessionary scenario would be a lot higher. So assets would be marked down by 50%, whereas, properties would be marked down by 30% for these OLV scenarios. And then what we would take those and we'd discuss with our risk team, the people that sign off on these loans, and say, hey, we're lending today against the CMV. And in a worst case scenario, if this thing goes down by 30%, are we still underwater? Meaning, is the loan value below the OLV level, or do we still have enough security in that OLV scenario that we're not underwater and the loan equals the OLV or is less than the OLV? So when you're talking about loan to values, it's all about protection. It's all about worst case scenarios and liquidation events. You always want to make sure that your loan to value is below 100%, because if you're at a 100% scenario, then the value of the asset equals the value of the loan, and you have no buffer in a worst case scenario. So that's why typically lenders will lend 75% or 80% against an asset to factor in that buffer, to factor in that potential decline to an OLV level instead of current market conditions, okay? And so ultimately, the gap between CMV and OLV is greater for illiquid assets and is typically closer for more faster moving potential sales. So say, for example, for inventory, okay? So I'm lending against, and this is like a very extreme example, I'm lending against seasonal clothing, okay, winter clothing that's in stock right now, okay? It's in fashion today. And so, we'll value this inventory at $1 million. Now, the OLV for that in a worst case scenario, if the business is underperforming, we're in a recession, whatever the case is, well, that OLV is going to be probably like 70%, maybe 80% less than the CMV, simply because there's not a lot of people looking to buy winter jackets in the summer 2 seasons from now in a recession. Right. So the discounted value is going to be very significant. So there's going to be an 80% markdown. Whereas, say, for example, for a property, that markdown may be only 30% because, yes, a recession would result in property values declining, but not by 80%, maybe 30% or 20%. So that's why lenders change the OLV markdown based on the underlying asset. And obviously, it's price sensitivity. Now, another term to use, and in the first part of the video, in the part one of these terms and definitions series, we talked about the term amortization, which essentially means to pay down the outstanding loan principal. I'm amortizing a loan, and therefore I'm paying the outstanding loan balance down. And so amortization is typically defined in terms of years or months. So if I have $1 million, I borrowed $1 million, and I'm amortizing that loan over 5 years, that means $1 million divided by 5 is $200,000, or $1 million in the equivalent monthly equivalent would be $1 million divided by 5 multiplied by 12 months or 60 months. So $1 million divided by 60 months is $16,666. So amortization is a fairly easy topic to understand. It's the pre-agreed upon pay down rate for the loan balance that you're going to pay either monthly or quarterly or annually, whichever way you agree to that amortization. But a cash sweep is a bonus to the amortization payment. So in addition to the scheduled amortization payment that you've agreed to up front, a cash sweep is typically triggered at certain milestones in order to accelerate the amortization of a loan. And so typically lenders will write in a cash sweep when there are either good things happening or bad things happening. So lenders will either see the business doing really well and say, hey, listen, you're going to have to share some of those rewards by paying down our loan quicker. Or if the business is underperforming, in that scenario, they'd say, listen, we don't want to be as exposed in terms of our loan value, and therefore business is declining. We're going to want to make sure that our loan is paid back quicker. Now, these things all depend on the type of situation, but ultimately the underlying concept of a cash sweep is that the business is not a steady state. Things will change over time. And if they change for the positive, as a lender, I underwrote the loan and I did the loan when you were doing this. Now you're doing much better. And therefore, I, as a lender, should share in those rewards and get this bonus cash sweep against the loan principal. And so I'll give you an example here. So if the business outperforms and the lender prefers to see their loan paid down more quickly, they could write in the agreement that if company ABC generates in excess of $1.5 million in profit, 25% of that excess is used to pay down the debt principal. So if I lent to your business and it was doing only 1.2 in day one, and now 3 years later you're doing 1.5 and doing maybe even more, 1.7, well, anything above 1.5, I get to keep 25% of, and that is what's used as the cash sweep to pay down the loan. And so typically cash sweeps are used in favorable scenarios. In down case scenarios, you don't want to accelerate the loan and force the business even into a tougher position. So most lenders will use cash sweeps in a positive scenario. Other situations I've seen cash sweeps used is when they trigger a sale of a certain asset. So we had a situation where we lent against 2 properties, and there was a cash sweep that said in a scenario where you sold one of the properties, then you had to pay X off in the loan balance, in addition to the pre-scheduled amortization. So those are kind of the types of milestones that may trigger a cash sweep. Now, a default is when the loan agreement is breached. And so this is bad, essentially. So you've broken your promise to a lender. You've defaulted on covenants that you've said either we're going to maintain financial performance at X level, or you were going to do something and you didn't do it, or you paid a dividend when you said you weren't going to do it. So defaults is essentially breaking a promise and breaking the agreement that you signed between the lender and the borrower. And so defaults range in severity. There are technical defaults where there's maybe a negative covenant that was breached and it's very minor. And there could be financial defaults where the business is really underperforming and just the fundamentals of that industry have declined to a point where now it's seriously potentially in bankruptcy. So defaults range, and therefore the corrective actions that a lender will take depend. I've had past clients when I was a lender that would default simply on some, dividend rules, or not sell this asset, or, don't do M&A without our permission. And they would go on and do it simply because they forgot about that covenant promise that they made. And then we'd go and we'd see, oh, hey, you bought that company. You weren't allowed to technically without our permission. So you're technically in default, but I'm going to go talk to my risk manager and they're going to waive the default, and just move on. So that's like a very non-serious situation. The opposite is, COVID hit and some of my clients, seriously saw an 80% decline in their business. And obviously they were all in breach of their financial covenants, and that's a material decline. And therefore, they were moved into special loans, and, we had to trigger, liquidity events and the like. So it all depends on the type of severity around the default. But, typically the most common default that you're going to see when you're a lender is missing a scheduled principal or interest payment. Either the business is underperforming or they don't have the cash on hand to do it and they're waiting for customers to pay them and they miss a month. And so when that happens, it's a tough conversation, but you have to sit down with that borrower and look at their situation and say, are we comfortable in giving them some time to pay us back? Or do we need to step in and begin to correct that business and potentially take it over so that we can recoup our money? Now, breaching a covenant is the second most common thing, and I already kind of talked about this in my personal experience, but going back to part one, in part one I talked about the various covenants that exist. There's the financial covenants. So if the business underperforms financially and it breaches its debt service coverage ratio, so it falls below 1.2 or 1.3, whatever the covenant was agreed to, then you've breached a financial covenant and you're in default. It could also be a positive covenant. So the business has agreed to maintain a certain level of security in a cash account as collateral, but the business decides to take that cash and use it for their own personal use. They broke a promise that they were supposed to make and continue to deliver on, and therefore, they've breached a positive covenant. Or it could be a negative covenant. So a borrower has agreed to not pay themselves a dividend so long as the lender is there, and they need to get permission from the lender, and the borrower ultimately does pay a dividend because they forget or they just don't care that the lender is not going to do anything to them, and therefore they've breached a negative covenant. And so whenever a default happens, technically a lender has the right to accelerate a loan in its entirety. So if I've lent you $1 million, you've paid down $100,000, you then default in year one. Well, now that $900,000 that is due, if I was going to be an ass, I would accelerate it in full and you'd have to pay me. Now, lenders don't typically want to do that only in a worst case scenario, because in a worst case scenario, the business is already dead. It's in bankruptcy. So you trigger the bankruptcy and move quickly to sell assets and try to recoup as much as you can. But maybe the business has stumbled a little bit or just made an honest mistake. Well, you're not going to trigger the loan and accelerate it in full. You're giving them the time, give them a warning, and then move on. So again, that's some background on defaults. Now, a term sheet is essentially a formal summary of terms submitted by a lender to a borrower. And so this is essentially the menu of items that summarizes our potential agreement. So what you'll typically see is that a term sheet is used and referred to as the agreement that is being signed between the lender and the borrower. So here's kind of my term sheet. Here are the terms of our term sheet. This is a term that you're going to use very frequently when you're working in commercial banking. But just to clarify, sometimes people make the mistake. The term sheet isn't the actual legal agreement. The term sheet is kind of a non-binding summary of terms that is used for discussion purposes, whereas the offer of finance is the actual legal binding contract that a borrower is going to sign to commit themselves to a loan. So that's why it's really important when you're talking about term sheets or offer of finance, which one is it really? And most kind of senior commercial lenders, they're going to really kind of provide a distinction. And sometimes, even prior to a term sheet, there may be a discussion paper. So a discussion paper is a very high-level term sheet. It's, not very detailed. It's not signed off on by your risk team. You kind of barely invested any time in negotiations, and it's your kind of starting position. And then that borrower is maybe going to push back on some terms, want a lower rate, maybe a shorter amortization, whatever the case is. And, you kind of go back and forth, and eventually you lock down a term sheet. That term sheet's signed, you go through the process of underwriting the loan, doing the full research, and then only once the loan is approved does an offer of finance get issued, and that is a legally binding document. So term sheets are things that are more non-binding summary of terms. And so some of the things that you're going to see in a term sheet would be the interest rate on the loan, the amortization, the term of the loan, covenants and conditions that are required to fund the loan, a summary of the security that you're going to take for that loan. So I'm going to register a lien on the property. I'm going to register a lien in the equipment. I'm going to have a first position GSA, whatever the case is. And then also a summary of the fees that the bank is going to take. And typically banks charge an upfront fee, and then they'll charge an annual or quarterly fee to maintain the account for all the ongoing work that's required to support a loan. So I kind of referred to it on the last page, a condition precedent. This is another term that, lenders will use. And so a CP, a condition precedent, is essentially a list of agreed upon terms in a term sheet that need to be completed in order to complete the loan, satisfy the lender and their due diligence, and fund the loan. So typically what you're going to see is that, you have a few outstanding CPs that need to be completed before his loan is funded. That essentially means you have to finish all of these conditions precedent before you can fund the loan. And so typically CPs that you'll see in term sheets and stuff that, lenders want to see before they complete the loan is obviously the most recent financial statements. Always before you fund a loan up to the day of that funding, just get the most recent month-end financials. Just make sure that the business is on track, is continuing to do well. It may be an equipment appraisal, a formal signed off equipment appraisal by a professional third-party equipment appraiser, just getting confirmation of the asset that you're lending against and the value of that asset. It could be an environmental report. So if you're lending against a piece of property, you want to make sure that it's not environmentally contaminated, which would impact the value of that property. And so you get an environmental report and you put that in the term sheet and you say, hey, I'll lend you this money, but a CP is that you have to get an environmental report that promises and guarantees that the current property has no environmental issues. And so then the borrower will take that term sheet. They'll say, fine, I need this money, so I'm going to go pay for the report. I get the report. I bring it back to the lender. I fulfill all the CPs plus this one, and then I get the money. Okay. Another example would be documentation for the shareholders, personal net worth statement, passports, scans of the passports, references, to confirm their good standing with customers or whatever the case is. And also customer supplier calls. You may call on a business's customer and to confirm that, hey, are they a good business? Are they, what's your payment terms look like? Do you really see, a lot of potential in this industry? Just to kind of get a general sense of the industry. You call the suppliers to make sure, hey, are they paying on time? Are they good payers? What's the financial stability of the relationship? Do they like you? Do you like them? And just kind of get a general sense. So there are different things that lenders can do as a CP. And so ultimately, it just lists out kind of a laundry list of the to-dos before the deal that I put in front of you can actually get funded. Okay, so these are kind of some more basic terms that you would use in your day-to-day commercial banking career. Hopefully you found the video helpful. Again, it's a little bit more technical and I kind of call it more medium level terms. But if you found the video helpful, please do like and subscribe to the channel and share it with your friends. And if you have any questions about any of these terms or other terms that you want to cover on the channel, just please comment below and happy to kind of get to those whenever I can. Other than that, hopefully you found the video helpful and have a great day, guys. Thanks.